The lower your cost of capital, the more you can pay, which means the more deals you can do. My name is Nick Burton, Director of Acquisitions for Legacy Wealth Holdings, and today I'm going to be going over the blended cost of capital and how we're getting cheaper money, a blended cheaper money, and doing more deals and better deals. This is my biggest, probably the biggest thing in my last 10, 11 year career that I wish that I knew early on, because I would have done way more deals and way better deals if I knew how to get a blended cost of capital down. If you don't know what blended cost of capital is, there's 4 places that you can get money from, or at least that we get money from. One is our own money, which we rarely use. We're big OPM, other people's money people. So your own money is the cheapest money. That's at 0%, right? 0% money. The most common money is bank money or lender money. That could be anywhere from 6% to 12% or 13%, depending on if you just get Fannie Freddie debt or if you go get a bridge loan. But it's probably in that 6 to 10% range money. Most expensive money, or potentially most expensive money, is your investor cash. So we typically pay 10 to 14% preferred returns. So that's the most expensive money. The last one, number 4, is the most flexible money. This is where you can really adjust that blended cost of capital, which I'll dive into a little bit more, is seller financing. The seller's money has potential to be the cheapest other than your own money. The banks are all about the same. Our private investors are accustomed to paying a certain rate, but a seller, it could be 1% interest, it could be 20%. It can go for 2 years, it can go for 20 years. It's endless possibilities. And when you take all these different interest rates and all these different amounts, you get a blended cost of capital. The lower your cost of capital, the more you can pay, which means the more deals you can do. Now, I'm not saying just because you get really cheap money, you should go do a billion different deals. But if I would have known how to structure those deals with seller financing, maybe get creative on the investor money. Bank money's bank money, that's the one I can't really adjust too much. But if I would have known how to pull these different levers, which I'm going to go over in the calculator a little bit, I would have done, the deals that I would have done would have been way better deals. And deals that I passed on because I couldn't get my money a little bit cheaper, I bet I would have taken a couple of those down. So now I'm going to dive into the deal calculator. I just added the blended cost of capital formula to it. I just added it today. So if you guys are interested and you want this calculator, it's totally free. It's going to be in the caption down below with the new features. Here's this part here. This is what I've built out. And we have our interest rate. We have the percentage of the deal stack of what that's going to be. And then we have that actual amount. So if you look over here on this left side, only the blue are inputs. You don't touch anything but the blue inputs in the calculator. So we have our market cap rate. We have our market vacancy. We have our current rent. This is all stuff that I go over in the tutorial as well, so I'm not going to do a deep dive into it. We have our pro forma market rents, after we renovate, after we get this thing stabilized, after we bring in our efficiencies of management, what can it get to? We have our CapEx budget. We have how many units it is, very self-explanatory, 22 units. Expense ratio, I'm just plugging in 40 for this example. Current occupancy, leaving at 100. Total purchase price, I have $2.8 million in here. Again, this is just a mock deal that I think will get my point across pretty well. And then here's where we have our loan amount, our equity raise, and our seller financing percentages. Okay. Down here we have our investor money of what that costs. This all ports over into the blended cost of capital over here. We have our mortgage costs, so our bank debt or institutional money. And then we have our seller financing portion down here at 3%. Again, all of this stuff is just showing over here. It's not any different. So if we look at this deal, And let's say we were to pay $2.8 million. Let's say, traditionally I start when underwriting a deal at we're going to go get a bank loan for 70% and we are going to raise 30%. That's where I start. I don't absolutely start with seller financing. My offer is always going to be with seller financing, but I usually submit two offers. One is, hey, if you don't want to seller finance anything, fine. Here's my offer. If you do, this is kind of where we would be, and I always try to shoot for the moon because worst they can say is no, or we end up somewhere in the middle. So I start with 70% and 30%. 70% loan at 6% interest. I know, pretty aggressive interest rate here. 10-year term, 25-year AM. Again, this is all subject to change on any deal. And then I have our equity raise at 30% at 14% preferred return. If we come over here, you'll see this property right now. If we were to pay $2.8 million, let's say the seller is stuck on 2.8. I'm not selling unless I get 2.8. No problem. If we plug this in, I have us losing about $7,000 a month day one. And after we raise rents, this is a pretty stabilized deal. It doesn't really need much work. We're just raising the rents $150. Maybe they've owned it for a little while. They're just keeping their tenants at the same rate. They're just not rustling any feathers. Let's say we can get $150 in rent bumps. Even after we do that, I still have us losing $6,000 a month. Not ideal. So let's say I go to Mr. Seller and I go, all right, if you're not willing to seller finance anything at all, let's say, what number works? I'm guessing it's going to be around, even at $2 million, it's basically a break even. Before I did that, our blended cost of capital is 8.52%. If I were to get 70% loan at 6% and 30% equity raise from our investors at 14%, that gives me a blended cost of 8.52% interest. Okay? That's about the most I'll pay for any money. To take down a deal, this is about where it maxes out for us. So what does that mean? This is the most expensive money that we get, which means it's the least. This will have our maximum allowable offer at the lowest possible amount. This is the worst case scenario that we can get. Anything cheaper than this means we can pay more. So if we were to pay $2.8 million and we were going to get a loan amount for 70% at 6% interest, and we were going to raise the equity, 30% of the purchase price, plus I have a rehab bulked in there too. It's not much, it's only $44,000. At 14%, you can see down here, that brings our blended cost of capital to 8.49%. So basically we're paying 8.5% interest across the entire thing. It's blended 6 and 14. The average of those with these amounts over here comes out to basically 8.5%. That's some pricier money. So what we're going to do is how can we make $2.8 million work? Obviously, we went over, we're losing $7,000 a month. After we get our pro forma, we're losing $6,000 a month. We need to bring our cost of capital down. That's the only way that we're going to be able to make this work. So let's leave the loan amount for right now. Let's say we're going to leave the kind of the middle cost of capital, the loan amount at 6% there. Let's try to beat up this 14% interest to our investors. Let's just swap this. Let's raise zero money. Really, we're just raising this $44,000 in rehab here, but it's a nominal amount here. And let's say we get the seller to carry back 30% of the deal at 3% interest only. So now at $2.8 million purchase price, which is what the seller wants, let's say we're still going to go get a loan for 70%. Hey, we'll bring 70% down through a bank loan. That's going to be at 6% interest. I didn't adjust that. Let's say we say, Mr. Seller, why don't you carry back 30% of this deal? You'll be secured in the new operating agreement, so it's not going to be a second position. Most banks will not allow a second position. Basically, you're going to be an equity partner in the new entity for 30%. We'll carry back 30%, which in this case is $840,000, 3% interest, 5-year term. Okay, that brings our blended cost of capital down by over 3%. So now our average cost of capital, we still have this 14% here just for the seller or for the rehab amount, but it's nominal. That brings our blended cost of capital down to 5.24%. So you can see, and now we're more than breaking even day one, and we're making a couple bucks here at once we get this thing stabilized and we're achieving those pro forma rents. But pretty good. We're making $76 per unit per month, which is a little light, but maybe there's some other efficiencies that we can get in here. Maybe we go in at, maybe we can get this seller financing money, or not seller financing, our investor cash on this $44,000 down to just 10%. It's not going to adjust it much, but at 0.06 of a percent, it's still something. Or maybe we say, hey, we're just going to take this out of cash flows, and that bumps it down to 5% interest rates, the blended cost of capital. Maybe we can get this at 2% interest only from the seller. And now we're down to 4.73%. Now these numbers are starting to look a whole lot better. Maybe we get a loan amount for 65%. So we're bringing down the bank loan amount, which is at a higher interest, 6%. We're bringing that down a little bit. Hey, I'm okay with less leverage because the seller's open to carrying back more paper. So now it's 65% from the bank, 35% from Mr. Seller at 2% interest only. Now we're down to 4.53% blended cost of capital. Let's go for a Hail Mary here. Let's say this seller owns this thing free and clear, right? Hey, Mr. Seller, Mr. and Mrs. Seller, why don't you carry back 90%? I'll bring 10% down, okay? I'll bring 10% down. I'm not going to go get a loan. This is a great thing for somebody who owns a property free and clear that has none of their stuff in order. I'm going through this on a deal right now. Some older people, probably in their mid-late 70s, pen and paper people, anybody. So I'm like, hey, can we get a rent roll and a T12? That's what I'm going to need to get this thing financed. And they go, yeah, here's a rent roll. It's just chicken scratch. And then I'm like, can I get a T12? They're like, no, we don't have a T12, but here are our expenses. And management's left out because they've been self-managing this thing for 30 years. They're also, every number on their expenses, there's only about 6 or 7 numbers. They're all round numbers. So $1,000 for this, $2,000 for this, $2,500 for this. No financial on anybody's expense statement is a round number, let alone all of the numbers. So you can tell they're just ballparking this thing. So if I were to want to go buy that deal where they don't have financials, I'm not going to be able to go get a loan on it. So there's 2 options there. One, I can go buy it cash and then get financials in order and refinance. Or 2, hey, why don't you seller finance this to me, just like this. I'll bring 10% down. You seller finance 90% of it to me at, let's say 3% interest only for 5 years. That will give me enough time to bring management in place, get real financials, and then in 5 years, I'll slap 5 years or sooner, I'll refinance, I'll slap real debt on it because I can actually go get a loan now, and everybody wins. So if I can get this thing seller financed, 90% of it at 3% interest for 5 years, and I try to push that out as long as I can. If I can get 10 years, I know some people that are getting 30-year. There's somebody in Legacy family that just got a deal. It was like 30-year seller financing, 0% down, 0% interest, no payments for a year. it's like impossible to lose on that deal, 0% interest for 30 years. It was crazy number. I think it was, I don't know, maybe 15 or 20 units. But like, you can shoot for the moon and you might get it. I mean, I don't think I've ever heard of better seller financing than that deal. But if you pay 2% or 3%, it brings your blended cost of capital. Again, if I pay, let's say I pay 14% for my equity here, for my down payment of this 10%. Let's say I get 3% on this 90%. My blended cost of capital is 4.25%, 4.25%. This is now exactly half of our starting interest rate, our blended cost of capital rate. We were at 8.49 before, we're at 4.25 now. I can pay exponentially more. Look, these deals are cash flowing a ton now. Now, instead of losing $7,000 a month, I'm making $7,000 a month. Huge swing. That's a $14,000 swing just by playing around with this blended cost of capital. Thanks for watching. Again, if you want this calculator with the new blended cost of capital in it, the link to it is down in the description. If you guys want a more in-depth analysis on how to lower your cost of capital, Bratz did a video a couple of months ago about 3 different ways to lower your cost of capital. That video is going to be right around here somewhere. If you guys have questions on this, join our free school group. Post in there whatever questions you have or comments, or if you want a feature added or whatever it is. I'm always developing this, trying to make it better. Go post in the school group and I'll check on it there. But thanks for watching, guys. Appreciate y'all.